intangible assets. So basically, so far in this textbook, we've moved through the balance sheet. We've talked about cash, we've talked about inventory, we've talked about accounts receivable, and all of those are current assets, meaning they're used up within a year or less, or turned into cash within a year or less, or we hope so, or we technically get rid of our inventory or write it down to zero if it's still there, and we're concerned about the collectability of accounts receivable. But fixed assets are another creature in that they are non-current since we expect them to last more than a year. So since we expect them to last more than a year, we spread the cost over its useful life. So if I bought a car for $30,000 this year, in my business, if it's going to last me 5 years, I want to spread that $30,000 cost over 5 years, and common sense would say it's around $6,000 a year. And so what that does is that kind of follows the matching principle. Otherwise, my financial statements will look a bit strange, like I have a $30,000 car in year 1 and then nothing in years 2, 3, 4, and 5. But since I'm using that car all 5 years, I want to spread that cost over the 5 years. So you have done some of this in the adjusting entries chapter. And so, please reflect upon that, and again, reflect upon a little bit of common sense in that if I have a $30,000 car and it's going to last me 5 years, common sense should say I'm going to take $30,000 divided by 5 and put $6,000 a year as the used up cost of that car. Okay, and now if you kind of get that base, some of this other stuff that is more complicated, maybe you can make it make sense. This is not necessarily a difficult chapter. There are a few things that will trip you up. So think of it as more of a trip up things in this chapter rather than difficult chapter. So the first thing that we're going to talk about are the major categories of plant assets. The first one are the ones that we generally think about. They're tangible, you can touch them, the car, the desk, all those things that are used in a business that aren't sold. So for instance, if I said a car, most of us would say that's a fixed asset. However, to a car dealership, a car is inventory. So generally, plant assets or fixed assets, that's the synonym, they mean the same thing. So basically, those are used in our business to do whatever we're in business for. So they're the equipment if we're a car manufacturer, the equipment to make the cars. If we're a car dealership, it's the building, the showroom floor, the desk, the computers, etc. For a car dealership, the cars are inventory, but certainly the dealership may have some cars that the owners drive around, etc. So again, it's not inventory. They're also not investments. So occasionally you might have a vintage car that you've invested in, or a piece of land that you bought for speculation because you used it as an investment. And like many things in accounting, we classify them based on our intent. So if I bought a piece of land for speculation, that is not a plant asset because I'm not using it to further my business. That would go in the investment section of the balance sheet. And again, if there was a situation where I had a vintage car and I was investing in it, that would not be a plant asset because I'm not using it to further my business. That would go in the investments. So again, I focus on intent. In this chapter, we generally go the normal route of, if it's a car, it's probably a fixed asset. So unless they tell you the intent is otherwise, assume those things that are normally used in business, buildings, equipment, etc., are fixed assets. Okay. Land is also unique. There are two fixed assets that are not written off. The first one is land, and the second one is goodwill, and we'll talk about that one in intangible assets. But the reason, think about depreciation is the systematic allocation of the cost of the asset over its useful life. So in my instance, I said I had a $30,000 car that was going to last 5 years. So I have $6,000 a year. That's a systematic allocation. Do I know exactly it's going to be $6,000 a year? No, I don't know that it's going to be $6,000 a year exactly, but I certainly probably don't want to spend the money on an appraisal every year or look up all my fixed assets. So if you just look around the room you're in and think about having to have the desk, the TV, the light, the pictures all appraised each year, and that would get very time consuming and costly to a business. So we just say we bought the car for $30,000, we're going to spread it over 5 years, and that's how we're going to systematically allocate it. Okay, so we'll talk about a situation where something is not systematically allocated, but land certainly was here before you were here, and it was here, will be here long before you expire and become part of the land. But anyway, so land does not systematically decline in value. Okay, so we do not depreciate land. So land just stays on our books. Now, there are times when land can become impaired. An impairment is not a systematic allocation. An impairment is a sudden decline in value. So if for some reason that you lived on a piece of property and a sinkhole opened up and suddenly half of your property is now a big hole in the earth, that is a sudden loss in value, and that's an impairment. And we do write down for that. But this chapter is mainly concerned about depreciation. It's writing off those assets that do decline in value over life. Land does not decline in value over its life. Systematically, for depreciation, it can become impaired. The next thing we're going to talk about, so we're major categories, intangible assets. Intangible assets are those things you can't touch. Since you can't touch them, we've created a legal system to represent our ownership. So if I write a song, or I have a trademark for my business, or I start a new franchise, I go into the legal system or make a patent, create something that I want to patent. I go into the legal system and file a piece of paper that says this is mine. Since you can't necessarily touch the patent, your songwriters can't, you can't touch a song. So those are intangible assets, and that's why we have those. Goodwill, on the other hand, is if you buy a business and you pay more for it than its identifiable assets are worth. Why did you pay more for that? And you may have paid more for it because of its reputation, its location, something that you can't quite put your finger on. And when you do that, you call that goodwill. So that's goodwill. That's an asset that you create. It's something that you can't quite identify and patent or copyright, et cetera, et cetera. The third category of plant assets or fixed assets or natural resources, they would include oil, minerals, timber, those type of things that are part of the environment. Okay, so I've kind of expanded this over here. So these are our concerns that we're going to go through in this chapter, and make sure you understand that. But basically, I'm going to simplify this over here, then I'm going to come over here. We buy it, we use it, we get rid of it. So we have to figure out what are the accounting implications of buying it, using it, and getting rid of it. And so I've kind of spread them out over here. Buying it, how to record the purchase of a fixed asset. What are some questions? What costs do we include? What if I buy more than one asset in a lump sum purchase, and so I don't know their individual costs? What about costs incurred after the asset is purchased? What do I do with those? And sometimes you could actually classify this question right here as in using it, but we'll get to that. Okay, then we buy it, we use it. Okay, so using it, how to spread the cost over its useful life. So we're going to get a little more complicated than simply I buy a $30,000 car, I use it for 5 years, so it's $6,000 a year. Okay, jump to 4 is getting rid of it. But I've put a 3 in there that's kind of in using it. What if I change some of these estimates? What if I bought the car for $30,000 and I said it was going to last me 5 years? and I find out, gee, it's going to last me 8 years, or what if I make a major improvement to it and make it last me 8 years? What do I do with that? So that's another concern. So we have 4 things we're going to talk about in this chapter. As you study, please, when you study, categorize them in your mind in these 3 areas, or these 4 areas, however your mind want to categorize them, and say, okay, what do I do to purchase it? What do I need to know? What are those things? Okay. So the first thing that we're going to talk about, let me make sure I've done that. Okay, the first thing we're going to talk about is what cost do we include in the purchase price. And as I go through these slides over here, I want you to simplify it to one simple thing. Everything to get the asset, I can type, ready for its intended use. Okay, so everything to get the asset ready for its intended use is added to the cost of the asset. Okay, and so I really want you to remember that and think about that as we go through here. And you will do that on a lot of assets. So for instance, we did it on inventory. Freight in was spent to get the asset ready for its intended use to sell. So I added it to the cost of the asset. When you did marketable securities and you paid a broker's commission, you added that to the cost of the security that you bought. So we're going to do the same thing with fixed assets. Everything to get the asset ready for its intended use is added to the cost of the asset. Okay, so I'm going to delete that there. Okay. Okay. So know as I read through this that general rule. So what do we add? We add sales tax on the purchase price. That's added to the cost of the asset. Delivery cost, installation costs. The thing that we don't add to the cost of the asset are things that are not reasonable and necessary. I really like to add, you didn't expect them. So when I, let's say that I negotiated the purchase price of a car. Okay, what am I going to pay for that car? And let's say that it is a 2012 Camry. Okay. So knowing that it's a 2012 Camry, you might have in your mind what you're going to pay for that car. Now if I add, well, that 2012 Camry needs new tires. So now you have mentally dropped your purchase price because it needs new tires. Or let's say it needs a new windshield. Again, you have altered your purchase price because you know when you purchase it, you're going to have to spend that. And when you spend that new tires or the new windshield, you're going to add that to the cost of the car on your books. And in the end, it may get up to the equivalent value of what you would have bought a Camry for without needing new tires or without needing a new windshield. So we always add to the cost of the car those things that we expected to incur. However, if something happens that you really didn't expect, so let's say that machine or the car, when we're unloading it, we backed it into a wall or we damaged it, etc. That should be a repair because it wasn't really part of my negotiations in the purchase price. Okay, so those are expense. Those are not added to things. Now, again, if the machine was damaged when I went and bought it, my purchase price has just dropped, so fixing it was expected to get the asset ready for its intended use. This was not expected, so don't add it. Okay, another thing that really is beyond the scope of this chapter is if we build something, we add, like you're going to build a building, think about it, you add the walls, the drywall, the electrical, that's all added to the cost of the building. And honestly, also if you build it and you incur interest charges during building it, you add that to the cost of the asset because you would expect to do that. However, if you paying for something, no, I want you to notice this is during construction. Okay, so once the construction period ends, you no longer add the interest charges. So similarly, when you buy an asset, you're not constructing that asset, so you buying an asset, you do not record interest charges, and a good significant portion of the time, those interest charges are actually paid in the period after you start using it. So they're really not spent to get the asset ready for its intended use. The intended use has started, and then I paid interest expenses. So think of it this way. If I bought a machine, the first time I plug in that machine and start running it to make product, that's my intended use. So if I start running the machine and I run a few pieces of inventory through it to test it and get the specs right, etc., all those items are added to the cost of the asset because I haven't started using it for its intended use. A building, if I'm building it, everything I add to it before I open the door the first day to get my customers in is added to the cost of the asset. So really focus on what is its intended use. Okay, so I have this one over here, so I want you to write it down, and we're going to make the journal entry for it. So a factory in Mississippi orders a machine from Colorado. The tool manufacturer has a list price of $10,000, so we know that's generally always added. So write cost of machine, $10,000. Payment will be made in 48 monthly installments, 250 of which include 2,000. Okay, in 48 monthly installments of 250, which include 2,000 of interest charges. Okay, so all 48 monthly payments would include 2,000 of interest charges. If I add this, I will be double counting because 250 times 48 is some number minus 2,000. It should be $12,000, by the way, because I'm paying for the machine of 10,000 plus 2,000 in interest. So adding this will be double counting. I've already counted the cost of the machine. I don't need to include paying for the machine again. And we also said that if we're not building it, interest charges are not included. So I'm going to cross these out. Those are not included because first of all, I don't want to double count the 10,000. And second of all, I'm not building it. So the $2,000 interest charges are not relevant. Sales tax of $600 must be paid. I haven't started using it before I spent it, so I'm going to add the $600, so sales tax. Freight charges, that was a cost to get the asset ready for its intended use. Installation, I had to do that to get it ready for its intended use. And I added this, also assume that a wall was damaged while installing the machine and fixing it cost $700. I did not intend to do that, so it is not added to the cost of the asset. Had the wall been there and I had to move it, and I knew I had to move that before I installed the machine, it would be added to the cost of the asset. But so here's my total, $12,450. Okay, and let's actually go ahead and make the journal entry for this. So what I would do over here, and make sure you write out that list, but this is a machine. So I'm going to debit machine. Do not debit machine for anything but $12,450. It is no longer all these individual items. It is simply a machine for $12,450, and then I have cash or accounts payable or whatever the heck I use to pay for it, $12,450. So now I only have a machine for $12,450. These individual costs are irrelevant. I will not use those anymore in my accounting system. The machine only appears as $12,450. Okay. Get rid of that. Okay. Next one. We're still in what's added to the cost of the machine. So think about getting land ready for its intended use. Some of the things that you would have spending to getting land ready for its intended use are commissions, escrow, legal, delinquent taxes, etc. All of these expenditures are added to the cost of the land. So I have one debit to land, which includes the sum of all those numbers. Let's say that I bought a piece of land with a building on it. So picture that. We've got a piece of land here, and we have a building on it. Okay? So my question is, do I need to split out between the land and the building? So do I need to debit land and debit building and credit cash? What do I need to do with that? And the answer is, what am I going to use this building for? If the intended use of the land is to build a new building on it, and I'm going to demolish this building, I add nothing to building because I'm not using that. I bought this, and my intent of this piece of land is to build a new building. So everything that it takes to get the land ready for its intended use, which is to build a new building on, is added to the cost of the land. So that would include the demolition of this. So I would add to land right here, this number, the cost of everything, the building and the land, and I would include the demolition of the building, the grading of the land, etc., everything until I started putting the new building on it. And then, as I built the new building, I would add the cost of the purchase to building. Okay, alternatively, I could buy a piece of land, and my intent was to use the building. In that case, if I paid $150,000 for it, okay, and I assigned $100,000 to the land, and we'll get to a lump sum purchase in just a second. But let's say that the land was appraised at $100,000, the building was appraised at $50,000. I'm going to debit land for $100,000, debit building for $50,000, and credit cash because my intent was to use the building. Okay, so make sure you know that if your intent is to tear down the building when you buy it and not use the building, the entire purchase price is charged to the land. Okay. My clicker is not working. Okay. There's also land improvements. Land improvements are things that kind of are attached to the land, but they do have a life. So since they have a life, remember, land doesn't have a life, so I don't depreciate it. But since these have a life, we do have a fixed asset called land improvements, and we do depreciate this because you have seen an old abandoned building that the parking lots and driveways are quickly grown up by trees, etc. So certainly driveways, fences, parking lots, landscaping, sprinkler system all have a limited life. So since they have a limited life, we do need to depreciate them. Okay, buildings. Again, anything that is added to the cost of the building before it's started used for its first time is added to the cost of the building. So you can read through those. Equipment, again, the same thing. Anything spent after we start using it is an expense. Okay, so if I got my building repainted before I used it for the first time, then that's added to the cost of the building. But then after a week or two, somebody damages the wall and I have to repaint a wall, etc., that's an expense because of a repair expense. So everything that's added to the cost of the asset itself kind of stops. There are a couple exceptions, but kind of stops when I use it for the first time. All right, the next thing we're going to do is what happens in my example when I purchased my land and building, and I said one was 100, one was 150, that I just debit land for 100, building for 150 in cash. But what if I went to an auction and it was appraised at 100 and 150, but I only paid 130 for it? So I know I've got a credit cash for 130,000, but what's my debit? How do I adjust that? Do I still debit land for 100,000, building for 150,000, and then things don't balance, so I need a credit? So do I do a gain, or what in the heck do I do? And the answer is you just proportionally reduce it. So think about that. If I bought a piece of land only, and the land was appraised at 150,000, and I bought it for 130,000, think about that. Land was worth 150, and I bought it for 130. You still debit land for 130 because that's what I paid for it. Okay, so similarly, if I buy a land and building that's appraised at 150,000 and I only pay 30,000 for it, I know I'm going to debit them for what I paid for it, the 130. And how do I do that? Well, I just simply say, okay, in my case, get this drawn here. In my example, I said the land was worth 100,000, the building was worth 100 or 50,000, so the total is 150,000. Okay, so if you think about this, the land was worth 2/3 of the appraised value, and the building was worth 1/3 of the appraised value. So I'm simply going to give the building 2/3 of the purchase price and the land 1/3 of the purchase price. Okay, so if you only have two assets, you can do that quickly. But in this case, assume that they purchased a complete fitness center at a bargain price of $800,000. But notice the appraised value was $1 million, and the appraisal valued it at land of $250, built land improvements, that's the sidewalks, etc., buildings, etc. So what I do first is I say, okay, well, I know my credit has to be $800,000 to cash or notes payable or however I paid for it. But what are my debits? Because I know they have to add up to $800,000. So what I do is I just figure out, okay, what percent of the purchase of the appraised value is each of these? So 250 divided by $1 million is 25%. 50 divided by $1 million is 5%, et cetera, et cetera. So now I have the percent of the appraised value that they are, and then I say, okay, well, if this is 25% of the appraised value, it's going to get 25% of the purchase price. So 25% of that, etc. So again, if you have done this in life all the time, figured out, all right, well, if I have to allocate things, I'm going to allocate things based on a percentage, and that's all I'm doing here is figuring out, all right, it's 25% of the appraised value, so it should get 25% of the purchase price. This should get 5% of the purchase price, etc. See if I made my journal entry. Okay, so here's what it ends up to be. I, in essence, ignore these because I can only record an asset at what I paid for it, and I paid $800,000 for it, so I somehow have to allocate $800,000 to all the assets I did. So I use these values to determine the percent, and then recorded at $800,000. So these are the values I do. So I debit all of my assets and credit cash. Okay, so stop and think about that and practice these, and these are easy to listen to and go through, but sometimes when you get to them, they're a little bit difficult. So make sure you practice them, and hopefully you're writing these down. Again, as I'm going to continue to say, if you don't write them down and practice, you're a great spectator watching me get better at it. You need to practice and get better at it yourself. Okay, so the next thing we're going to talk about is a capital versus revenue expenditure. I generally call them repair. I don't like the term revenue expenditure because it makes you think it's a revenue. It's actually an expense. So these mean that it's part of the income statement. Okay, so capital expenditures. So the question is, we've all seen buildings that have major remodels done to them. So if you ever watch HGTV, which I don't get cable to watch, but my Roku has some, and I enjoy watching it. But so if you watch HGTV, sometimes they just completely gut a house or a building, etc., and it ends up as like a new house. So the question is, when have I really changed the asset itself, and when have I just repaired it? Okay, so a capital expenditure, you actually would add it to the cost of the asset, and we do those when we purchase it, and it's a little bit easier because, all right, everything that you add to the cost of the asset to get it ready for its intended use is added to the cost of the asset. But after I do that, what is the dividing line between when I have a new significant change in my asset and when it's just a repair expense? So the question is, well, let's go through this then. Capital expenditures you record in the asset account. And I like to say a couple of rules. I don't know if they have this later on. If it significantly improves the asset, or it significantly extends the useful life, you have a capital expenditure. And by the way, sometimes accountants in the field disagree with us, and they argue back and forth on what it's done. A revenue expenditure, notice revenue expenditures are recorded as expense accounts, and they simply maintain the asset into its current state. So if you think about changing the oil, we all know that we're going to have to change the oil in our car. We all know that we're going to have to put new tires on our car. So think of it this way. Don't think about it as, if I don't do it, the asset life will go down. Because certainly if I never change the oil in my car or never change the tires in my car, someday I might be in real trouble. So don't think about that way, but think about it, does doing it significantly increase the useful life or its value? Okay, and I don't mean overall, I mean this time. So let's say this time when I change the oil, does it significantly increase its useful life or its value? And the answer is no. And this time, replacing these tires on the car, does it significantly increase its useful life or its value? And the answer is probably not. So when you buy it, you're going to have to do it over and over repetitively. Okay, so let's go through a couple examples on this. Notice I say debit repair expense. There are some exceptions. There are some other things that you can debit. So for example, on if I buy it, this is a good example for up here. Okay, if I buy a truck and I want to put my business name on the side, and I hire somebody to paint my business name on the side, or get one of those stickers or something, what do I do with that? Well, the answer is, if I haven't used the truck yet, it's a cost spent to get the asset ready for its intended use. It's added to the cost of the asset. Now, after 4 or 5 years, I change my name of my business and I want to put a new decal or a new paint on the side of the truck with my new name, etc. What am I doing there? Well, I know I haven't used the asset for its first time, so it is not automatically added to the cost of the asset. So I'd say, okay, well, I spent $1,000 getting my name changed on the side. What do I do with it? So I ask myself 2 questions. Does it significantly increase the value of the truck? And the answer to that is no. If somebody else bought it from you, they're probably going to not want your ad name on it. And does it significantly extend its useful life? And the answer is no. Paint on the side of a truck does not significantly extend its useful life. So now I know I expense it, but what do I expense it to? And the answer is that's advertising expense. Okay, I'm painting the name on the side of the truck for advertising expense. So I debit it to advertising expense. For most of the places, though, it's repair expense because I'm dealing with changing the oil, etc. Okay, so let's go through this one. So I spent $400 changing the oil and replacing spark plugs. So I asked myself 2 questions. Does it significantly increase its useful life or its value? And the answer is no, so I expense it. So I'm going to debit repair and maintenance expense and credit cash. Later that year, the company replaced the engine of the truck at a cost of $4,000. The truck, which was supposed to last 6 years, is now expected to last 8 years. So now I ask myself, does it significantly increase its useful life or its value? And at least it does its useful life, okay? So I'm going to debit truck for $4,000 and credit cash for $4,000. There is a time when you can actually debit or accumulated depreciation because I'm getting some of its life back, but I don't think this book talks you through that. But anyway, I'm going to capitalize this because it significantly increases the truck's value or its useful life. If I put a lift bed on the truck, it would significantly increase the truck's value and it's changing the asset, so I'm going to debit it to truck. Okay? All right, next thing we're going to talk about is how to spread the cost of the asset over its useful life. And remember, depreciation is the systematic allocation of the cost of the asset over its useful life. Some terms that you need to know is book value. Okay, and we have these back in the depreciate or in the adjusting entries chapter. So book value is important because remember, I have it's frustrating. I have 2 accounts for the truck. I have the truck, which is the cost of the truck. So in this case, it's $17,000, the one we're going to get to. And I know the truck doesn't disappear, so I make up an account to hold the write-offs, and that account is called accumulated depreciation. So let me change this to $10,000. So I have a truck that costs $10,000. I say it's going to last 5 years, so that's $2,000 a year. So after 1 year, I have accumulated depreciation of $2,000. My book value of that truck is now $8,000. Another year, I put another $2,000. The book value is now $6,000. Another year, I put another $2,000. The book value is now $4,000. Another year, $2,000. The book value is now $2,000. And the last year, $2,000. The book value is now $0. So when it's fully depreciated, I've got a cost of $10,000 in the truck, and I've got $10,000 in accumulated depreciation. And you can see the book value is $0, but according to my records, I can see I still have a truck. And so I have some control over it because that truck is on my list, and people will go make sure that truck hasn't disappeared and things like that. Okay, so cost minus accumulated depreciation is the book value. We know from a prior chapter that depreciation is a contra asset. Please don't put depreciation, because it's accumulated depreciation is the contra asset. We also have depreciation expense. Depreciation expense is just the depreciation taken in that particular year. Accumulated depreciation is the sum total of all depreciation taken in prior years. So add accumulated depreciation to that. And causes of depreciation, either physical deterioration or obsolescence. We all know that cars don't last forever, and we all know that cell phones last a lot longer than we can actually use them, because they can probably, most of you at some point, or everyone that's owned a cell phone for a long time has sometimes had to upgrade, simply because the computer or the cell phone will no longer accept the software. It's just now obsolete. So those are causes of depreciation. Okay. Oops. Get rid of that. All right, straight line depreciation, we've basically done it. We said we had a $30,000 car that lasted 5 years, so it's $6,000 a year. We add one thing. If we have a residual value, remember, it's basically I want to depreciate it how much it's going to decline in value. So if it's only going to decline in value, let's say I have my $30,000 car, I think I can sell it for $5,000 at the end. So it's actually only going to decline in value, 30,000 minus 5, or the 25,000. So I take the cost minus how much I think is going to be left. That's the numerator is always the decline in value. Again, this is an estimate, but I think a lot of us could say, all right, well, I at least can surely sell my car for $500 at the end of its useful life if I'm going to keep it. But, you know, some people have, well, I know that I want to sell my car when it reaches 70,000 miles because I know it has a residual value of around that, etc. So, again, these are guesses, but they're educated guesses. And so is the years of useful life. It's a guess, but it's an educated guess, because we want our financial statements to be reasonably accurate. Fraud has happened by misstating names. A famous case of fraud was in Waste Management, where they simply said their trucks were going to last forever, so they didn't take very much depreciation a year because they didn't want very many expenses, because they wanted their net income to be higher. So certainly there's fraud involved in this, and we have auditors check on that, and the auditors should have caught it. Some auditors did, actually. But so that's the formula for depreciation: cost minus salvage value or residual value divided by the life. Okay. There's another method of accelerated depreciation. So straight line is we just spread it out over its useful life. A lot of companies use accelerated depreciation, and that is, we're going to call it double declining balance or declining balance, where they simply take mathematically more depreciation in the early years, because the idea is I kind of use up more of its value in the early years, and in the later years I'm going to be spending more on repair expense. So if I kind of charted repair expense in the early years, I have very little repair expense. So here's my repair expense. Okay, So in the early years, I have very little repair expense, but I have a lot of depreciation expense. And as the life goes on, I'm going to have more repair expense, so I have less depreciation. So either one of these methods is acceptable, and you have to be told which one they use. You can't know. Okay, so here's this one. Make sure you write it there. We have cost is $17,000 minus residual value of $2,000 divided by life, and the life is 5 years. So I have $3,000 a year. So I'm going to go here. This is what you're going to fill in. I didn't do all of these columns, but there's no reason to. I have my journal entry. So my debit to depreciation expense, here's your journal entry. Debit depreciation expense, credit accumulated depreciation for, this is $17,000 goes up here. Okay, so notice put 17,000, don't put 15,000. You do not use salvage value. When I bought this piece of equipment, I debited equipment for 17,000. That's my T account of equipment right here. Equipment has 17,000 in it. Okay. This salvage value, you'll see where it comes in. It's never recorded officially anywhere. Okay, so 17,000 there, and then in year 1 I have $3,000, year 2 I have 3,000, etc., because it's straight line. So I have $3,000 all the way down. Okay, I didn't put this one in because you notice I'm going to do the journal entry down here. My accumulated depreciation is accumulating. So in year 1, I put $3,000 in accumulated depreciation. And the next year I put 3,000 more, so now it has 6. And the next year I put 3,000 more, so now it has 9, etc., etc. So the important thing here is that you notice at the end of its life, I should have an asset. I still have my $17,000 in my equipment account, and I go to my contra assets. This is an asset. My contra asset is accumulated depreciation, which has added up $3,000 a year, and now it has $15,000 in it. Okay, added $3,000 a year, and so now my book value is 17 minus 15, or 2,000, and that will always be the salvage value at the end. That's kind of important next when we get to double declining balance. Okay, so your journal entries. In year 1 is depreciation expense accumulated depreciation, and year 2 it's depreciation expense accumulated depreciation. Don't make the mistake of putting $6,000 in the journal entry for year 2. That's a common mistake students make. You do not put $6,000 in there in year 2 because it accumulates. So this $3,000 is already in there. So when I add another $3,000, it now has 6. So first of all, your journal entry wouldn't balance if you put $6,000 in there. And second of all, you would have had $9,000 in accumulated because this $3,000 is still there. Okay. The next thing that we need to talk about is sometimes there's something called the half-year convention. Actually, you can keep track of your assets by month. So if I purchased it on July, let me not make July 1st. On February 1st, I would take, in the first year, I would own it for 11 months, so I would have 11/12. Businesses don't generally count days, they just count months. So a common thing for a business to do is use the half-year convention, or they just go to the nearest month that they own it. Remember, overall, we have thousands of assets generally. So some assets you might have bought in the beginning of the month, some assets you might have bought at the end of the month. So you take a whole month or half a month on them, etc. Consistency is the important thing here, rather than don't count days on an asset. I will never put, intentionally, I will never put an asset there that was purchased on the 12th of a month or on the 5th of the month, unless I tell you the half-year convention. Okay, so the half-year convention simply says, okay, we know some assets are going to be purchased in the first half of the year, some assets are going to be purchased in the last half of the year. We don't know the exact dates. We do know that we don't want to mess around with days, but how much do we even want to mess around with months? And the answer is maybe we don't. So what we do is we pretend we bought every asset on June 30th, if our year ends December 31st. So in the year of purchase, we take a half year. In the year that we get rid of it, in the first year and the last year, we take a half year. We assume we owned every asset half year. Some of them will be a little too high, some of them will be a little too low. It all washes out at the end. So what happens if you use the half year convention is our journal entry for year one becomes depreciation expense, accumulated depreciation for $1,500, and then year two it's $3,000. Notice I'll actually depreciate it over 6 calendar years, so $1,500 in year one, so that's a half year. Year two is a whole year. Year three is a whole year. Year four is a whole year. Year five is a whole year. But I need a half year in the 6th calendar year. So similar to everyone whose birthday is not on January 1st, you live a partial year, you live in different years. Your age doesn't always coincide with your years. That's what I'm going to say. Okay. So here's another example for the half year convention that I just didn't put on there, which you can kind of look through it if you want. Okay, remember you have these PowerPoints. The declining balance method, this is the accelerated method where I'm going to take more depreciation in the first year. So basically what is very important in double declining balance, and I would actually write it out here, you ignore salvage value until the end. You ignore salvage value until the end. So probably the biggest mistake in double declining balance is including salvage value in your computation. I've done it, other people have done it, etc. So I'm going to skip this one because I've redone one that looks more like mine. Okay, so if we have, I first compute the depreciation percentage. The depreciation percentage is 1 divided by the life in this year. In this particular case, my life was 5 years, I believe, up here. You can scroll up or look at your paper because you should have it in front of you. 1 divided by life, and it's double declining, times 2. So 1 divided by life times 2, 1 divided by 5 is 20%, times 2 is 40%. So I am taking a 40% depreciation rate. So I'm going to go down here and write 40% in these depreciations all the way down. Okay? Except don't put it in the last year. All right, you can leave that. If you put it there, it's not a big deal. But 40% depreciation. Now remember, book value is my cost of my equipment, which was $17,000, minus my accumulated depreciation. Okay? So that's my book value. And they have book value at the end. I put it in the beginning there. Okay, so in year one, my book value is $17,000 of cost minus 0 accumulated depreciation. My book value is $17,000. Okay, I'm going to multiply it by the percent depreciation times 40%, and I get $6,800 of depreciation expense. Okay, so my accumulated depreciation, I'll just circle it over here, is also $6,800. Okay. Now I know book value is cost minus accumulated, so cost minus accumulated depreciation is my book value, okay? So my cost is still $17,000, and my accumulated depreciation over here is $6,800. So $17,000 minus $6,800 is the $10,200. Take $10,200 times 40%, I get my depreciation expense now of $4,080. My accumulated depreciation is my $6,800 plus $4,080, so it's $10,880. And my book value, notice they just wrote book value twice. I just put it over here and didn't put it over there also. But now my cost is $17,000 minus accumulated of $10,880. It now goes down to $6,120, which I take times 40%, which is $2,480, $2,448. Now my accumulated is those three numbers added together. Notice you could just add that one plus that one. So now I have $13,328. My book value is $17,000 again, always cost minus accumulated. That gives me my book value of $36.72. So write $36.72 in year 4 Times 40%, I get 1469. So now my accumulated is all four of these numbers added up. So 14,797. And my book value is now 17,000 minus 14,797 is 2203. So now I write 2203 here. I'm really bad at this. Okay, but 2203 goes right there. All right. In the last year, remember, I want my book value to equal salvage value. And so when I'm taking 40% of a smaller and smaller number, I actually never get to the perfect. So in the last year, I just take the rest. And so I want, at the end, I can write it here, I want this to be 2,000. Okay? So in year 5, this is now sitting at 2303. And I know it's got a 5-year life, and so I just simply take the rest. So I put NA in there. My depreciation expense is simply 203. So notice your depreciation, your accumulated depreciation needs to be 15,000 because I want my book value of 17,000 costs minus 15,000 to equal your salvage value. Double declining balance. Don't use salvage value until the end, and you plug the number to it. Okay? All right, so this is not on the slide, but what happens if my half-year convention is used? Just be careful in using the half-year convention of you honestly have to redo the entire table because of the book values going down. So I just, in the next slide, kept the example for the first year, but I just want the first and second year. So I take 17,000 times 40%, but I assume I purchased it on June 30th, so I just take it times 1/2 year. So 17,000 times 0.40 times 1/2 year is $3,400. So my accumulated depreciation is $3,400. Now my book value is 17,000 minus 3,400 gives me my book value of 13,600. So 13,600 in year 2 times 40% gives you 5,440. So 3,400 plus 5,440, if I added right, is 8,840. And now my new book value is 17,000 minus 8,840 is 8,160. If I did a third year, I'd take 8,160 times 40%. The only real difficulty with half year is sometimes you get in a hurry and you think, oh, I owned it a full year the second year, so I'm going to go up here and grab this depreciation expense. Well, no, you can't go grab it because your book value is different than because I subtracted 6,800 here and I subtracted 3,400 here. So my book value throughout the life is different. Remember, also I would have, since I only took a half year in this year, I would have a 6th year, and the 6th year would be my plug because it takes 6 calendar years to depreciate a 5-year asset. Okay, so just remember to take a half year in the first year and then do your computation the same method as you did your computation before. Okay, next thing we're going to talk about is, well, you can read through these. Any business that doesn't really file financial statements, that only prepares their income statement for the IRS, and that's the only place they report to, will generally use accelerated depreciation. And there's a different depreciation even allowed in tax laws that allow you to write off big chunks of it. This is just a choice that businesses made, so you will have to be told what they use. So notice many companies use straight line depreciation in their financial statements and accelerated methods in their tax return. All right, what do you have to disclose? You have to disclose how you prepare your useful life. You don't have to disclose the useful life and the residual value for each individual company. You just have to kind of state your general rule for how you determine them. And once you use straight line depreciation, you have to stick with it unless there's a good reason. If you do switch, you can't switch back and forth. You have to disclose a lot of information on why you switched, how it's affecting, et cetera, and then you have to stick with it. So you need to have a consistency. Okay, so the next thing we're going to do is what happens when we decide our estimates are wrong. This actually happens quite a bit. I remember I worked in public accounting when computers were just desktop computers were coming in, and we thought, oh, well, you know, a desktop computer, everybody thought they would last 10 years. Well, after 3 years, we decided we were pretty wrong on that. So you need to revise your estimate. So assume a company acquires a $10,000 asset estimated to have a useful life and no residual value. At the beginning of the fourth year, they're going to estimate that it's going to last for 5 more years. So make sure you read these carefully, because we need to know how many more years it's going to last. So notice it's beginning of the fourth year, so 3 are gone. So it could have said the asset was going to last 8 years instead of 5 years, etc. The revised estimate is a total of 8 years. Honestly, what we're concerned about is 5 more. Calculate your depreciation expense. So what happens, remember, we have the cost of the asset. So this is our equipment, and it's $10,000. Okay? You can only depreciate up to $10,000. You cannot depreciate more than the asset than you paid for the asset. So what happens is we figure out how much is in accumulated depreciation. So I'm going to make this up, which is, I don't know, I haven't worked through this, but it wasn't, don't remember the numbers. Okay, so let's say that I took $1,000 a year for 3 years. Okay, so my accumulated depreciation has $3,000 in it. So revising an estimate is not that complicated. I've got a $10,000 asset. I've already depreciated $3,000 of it. I have $7,000 left to depreciate. I ask how many years are left on it, and I spread that $7,000 over its life. Now, I might have a new salvage value or a new residual value, and so again, at the end of the asset's life, I want the book value to equal salvage value, so I don't depreciate that. So I just simply compute how much of this $10,000 is left and subtract out what I don't want to depreciate and spread it over its remaining life. So we'll do that here in just a second. All right. Okay, so notice that I've got $10,000 at the beginning of the fourth year, so I've taken 3 years of depreciation. So first of all, I need to figure out my depreciation I took. Cost of $10,000 minus salvage value, not given in this problem, so I'm going to assume 0. Cost minus salvage value divided by life, and I said 5 years. So $10,000 minus 0 salvage value divided by 5 years is $2,000 per year. And this was at the beginning of the fourth, so I hadn't taken the fourth yet. So 2,000 times 3, I've taken $6,000 on it. So I've got 4,000 of the 10 left. And I said it has 5 more years, and I'm not given any more salvage value information. So 4,000 minus the salvage value, my new salvage value, because that's what I want left at the end, which is 0, divided by the remaining life is 5. So I depreciate $800 a year. So I simply just change it and fix it from then on out. What is an impairment? An impairment is when an asset is no longer, let me back up. The definition of an asset is current or future benefit. And if an asset doesn't have as much current or future benefit as you have it on your books for, you have to write it down. So if I have a piece of equipment that is on my books for $100,000 and new technology has made it worthless, I need to get it off my books because I don't want to mislead investors and think I have $100,000 worth of stuff that's pretty much useless. Okay, so this happens with land, but notice J.C. Penney had some issues with this. Again, companies deal with this, they have to write them out. So what happens with an impairment? So let's say I had land. Let me draw this right here. Again, I apologize. So I've got land on my books for $10,000. So land is an asset. I've got it on my books. Let's make it $100,000. Okay, so that's $100,000 all on the debit side. I just can't write very well. And let's say that I have discovered that my land is sitting on a toxic waste site, and my land is now worth not $100,000 but $10,000. So I need to get my land down from $100,000 to $10,000. So what do? I know I have to credit land. So I'm going to credit land for $90,000. So my question is, what is my debit? And it's $90,000. I know that. Well, notice that this was a decline in value, so I debit loss on impairment. Okay, loss on impairment is debited, land is credited. So I need to get that down to its current value, because I can't have an asset on my books that has no current or future benefit of what I've got it on there for. Okay, units of output depreciation. I kind of wish they'd put it up here with straight line and double declining balance, but they didn't. Units of output depreciation is pretty much similar to straight line, except its life is not in years, its life is in units. So, I'm going to go to this one. We had a cost, $35,000, estimated salvage value of $5,000, and they're going to retire this truck after it's been driven 60,000 miles. So, I take my cost minus my residual value, just like straight line, except instead of dividing by life in years, I divide by my life in units. And my units in this case are miles, and that will give me my depreciation per unit. So I have 50,000 per mile. So if in the first year I drive it 17,000 miles, my depreciation expense that year is 17,000 times 50 cents, or 8,500. I never have a partial year fraction, like I don't have to take it times a half year when I have units of output, because simply I would have driven it less miles, so it would have been automatically depreciated less. Okay, so units of output seems like a great thing to do. I have never really seen a lot of businesses use units of output, mainly because they have a lot of fixed assets, and at year end, just think about if you had a fleet of trucks and you had to tell all your drivers, well, make sure you report the mileage to me at December 31st. I need the last mile you've driven, and I need to gather all of that information. And honestly, it's just quite the task to go get all the miles driven on trucks, or hours of machine, or whatever you would need to do. Makers, just know the term. Makers is the term Modified Accelerated Cost Recovery System, is what we use for income tax. And quite frankly, it's based on the declining balance method, either double declining balance or 150% declining balances. Sum of the year's digits is another method. Just know the term. It's not often used, and this book doesn't cover it, so I'm not going to do that. Now the last thing we're going to do is disposal, and then we'll go through a journal entry. So the steps of getting rid of an asset, and they don't have this in here, but yeah, they do there. First, I update depreciation to the date of disposal. So remember, if you have the half-year convention, I take a half year in the first year and a half year in the last year. Then I get the fixed asset off my book. So if you think about it, equipment is usually debited, so I have a debit over here to get it off my books. I credit it. Accumulated depreciation generally has a credit balance, so to get it off my books, I debit it. So I can't have an asset that's on my books that's gone, so I need to get it off my books. I'm going to record the cash received, if any. Cash is a debit. And then the last thing I'm going to do is make sure my equation balances. So if I need a credit to balance, credits are revenues, and we call it a gain. If I need a debit to balance, it's like an expense, so I have a loss. All right, so I'm going to go through some examples, and you'll see it. You'll see the same thing. Okay. So assume a machine costing $10,000 had accumulated depreciation of $8,000. You don't really need to know that. A book value of $2 is sold for $3,000 cash. I don't necessarily go through this computation, but sometimes it's easy if you see it. Basically, I have the cost minus accumulated, means it's a book value of $2. That's why they didn't need to give that to you. And I got $3,000 for something that I had on my books for 2, so it's a gain. So let's go through the steps. The steps up here, they don't give me the date of disposal. They say it had book value, so I don't have enough information to get my depreciation up to the date of disposal. So now I get my fixed assets off of my books, so I'm going to go through these in the way I do it. The first thing I do is get the fixed assets off my books. The machine costs $10,000, so I credit the machine for $10,000. I had accumulated depreciation of 8, so I get it off my books with a debit. Remember, its normal balance is a credit, so I get it off my books with a debit. So right now I have, always put your debits first, your credits second. So I'll leave some space here. So I have a credit to my machine for 10 to get it off my books, a debit to accumulated depreciation to get it off my books. I got cash. Cash is an asset, so I debit cash. So now I have $11,000 on my debit side and $10,000 on my credit side. So I need a $1,000 credit to balance. Since it's a credit, it's revenue. I made money on it, it's a gain. It's just as easy as that. Let's go, make sure you practice it though, if you can kind of mess up sometimes. Next one. I think I intended to change that. Okay. I'll just delete. Now let's go on. Assume a fully depreciated machine originally cost $10,000. Notice it's fully depreciated. So I need to know how much depreciation is taken. Well, if it costs $10,000, remember I depreciate cost minus salvage value. So cost is $10,000, salvage value is 0. So I would have depreciated all $10,000. It's sold for $1,000. So I'm going to go through the steps. Update depreciation. Again, I'm not given dates, so I don't have to do that. Get the fixed asset off your books. I have the machine on my books for $10,000, so I credit it. Second step, get the accumulated depreciation off your books. It's fully depreciated with no salvage value, so I would have depreciated all 10. I sold it for $1,000 cash, so I debit cash for $1,000. I have $11,000 on my debits, $10,000 on my credits, so I need a credit to balance, so I have a gain on disposal. Next one. On September 30th, that's this one down here, so hopefully you're writing it down and practicing it. On September 30th, they sell a machine that originally cost $100,000 for $60,000 cash. The machine was placed in service in January 1, 2004. It's been depreciated using the straight line method with an estimated salvage value of $20,000 and estimated a useful life of 10 years. Okay, so feel free to pause these videos. I don't know what speed each of you goes, so there's really no need of dwelling on these things. You can pause them and read through them slowly. But notice I put it in service in X4 and I'm selling it on September 30th X7. Okay, so I am not told, I can go through the steps, I can start my steps of get the machine off from your books. Okay, well that's easy, $100,000, a credit machine for $100,000. Now I'm going to go to step 2 to get the accumulated depreciation off your books, and suddenly I find out, gee, I'm not given accumulated depreciation. And also over here, if I go, I need to update my depreciation to the date of disposal. I'm not given anything. Okay, so basically what I've got to do is go back and recompute. So first, I need to figure out how much depreciation I've taken. Depreciation is cost minus salvage value divided by life. So $100,000 divided by $20,000, and it had a useful life of 10 years. So $100,000 minus $20,000 divided by 10 years is $8,000 a year. So I purchased it on January 1st. So in X4, I took all $8,000. If I didn't purchase it on January 1st, or if I used the half-year convention, I would have taken 4 or some adjustment. Okay. In X5, I owned it all year, so I took $8,000. X6, I took all year, so I took $8,000. And in X7, it's $8,000, but notice I sold it on September 30th. So I owned it 9 out of the 12 months, so 8,000 times 9/12 is 6,000. If the half-year convention was used, I would have simply pretended I sold it on June 30th. I would have taken $4,000. Okay, so I know I generally record depreciation on December 31st. So all of these have been recorded, but this one hasn't. So first thing, update the depreciation to the year of disposal, to the date of disposal. So I have to record my September 30th depreciation, and then my accumulated will have a $30,000 in it. So let's go do that. So the first thing I need to do is record that $6,000 of depreciation expense. So I debit depreciation expense for $6,000 for X7 and credit accumulated depreciation. If the problem would have said half-year convention was used, this would be 4 and my $30,000 would be different. Now I can go through my steps. Get the machine off my books. So I get the machine off my books for $100,000. That's what it originally cost me. I get my accumulated depreciation off your books for $30,000. So generally what I do is just leave a lot of space in between these things. So I get the accumulated depreciation off my books for $30,000. That's what it was back here. These 3 have been recorded. I just added that one. Record the cash. I sold it for $60,000 cash. Now I have $90,000 on my debit side, $100,000 on my credit side. I need a debit to balance, and a debit is a loss. So in other words, I got cash of 60, and I had this machine on my books. The book value was $70,000. So I had it on my books for 70. I got cash of 60, so I had a loss. Okay, that's it. Practice those. Those are difficult. I shouldn't say that's it. I think I have a couple other things. Thought I was done. Okay, what happens if I trade in an asset for a new asset? Again, I get the old asset off my books, but instead of having cash, I got a new asset possibly. So look at these. I get the old asset off my books. So I have an old truck. They received a trade-in allowance, so sometimes you got to kind of work through this. I have the cost of the old truck, $10,000 cost. So my cost of my old truck was $10,000. My accumulated depreciation on the old truck is not given, but it has a book value of $2,000, so I know my accumulated depreciation must be 8 because the book value is 2. So that's what my old book is on my books for. So I received basically a $3,500 trade-in allowance, so I have $3,500 here. So I made a gain on the disposal of the truck. Okay, so these you really have to take slowly because you've got an old and a new truck going in here. So I take the old truck off my books, $10,000, get the accumulated depreciation of the old truck off your books, which is 8. Next thing that we would do is we would normally debit cash received, but in this case I didn't get any cash, I paid cash. Okay? So the thing I do next is say, okay, well, what did I get for it? Instead of getting cash, I got a new truck worth $25,000. Now take the cash and think, okay, I got a $25,000 less a $3,500 trade-in. I would have written that computation up here. So I paid $21,500. So don't get your debits and your credits mixed up. This cash is going out the door. And then I have a gain on my disposal. So honestly, this seems complicated, but if you think about it, I've got an old truck, old accumulated depreciation, new truck, cash, and gains. That's all of these things in here, and then I just have to decide what do I do with them. I got rid of the old truck, got rid of the old accumulated depreciation, got a new truck, paid cash, and then I record my gain. And you can also just plug your gain in the end and it'll all work out. Just don't forget one of the trucks, which is what I generally do. Read that yourself. The next thing that I'm not going to spend a whole lot of time on, mainly because an intangible is something that you can't touch, patents, trademarks, goodwill. we call these intangibles. You compute it just basically the same as straight line depreciation. You generally don't have a salvage value, but you could. And instead of calling it depreciation expense, you call it amortization. So intangibles, just give your example of what they are. Patents, trademarks, goodwill you don't amortize, but these generally franchise, you amortize them instead of depreciate them. But otherwise, besides debiting amortization expense instead of depreciation expense, notice the credit is to the asset account. Some companies actually credit accumulated amortization, but the theory is, since the intangible never existed physically in the first place, it is technically gone at the end, so we can just credit the intangible account itself. On your drop-down menus, you probably won't even have the option of accumulated amortization, so you couldn't choose it. So what I want you to know about intangibles is, what are some examples of intangibles? You'd call it amortization instead of depreciation, and you generally use similar to straight line depreciation. Okay, you can read through those. Straight line method is normally used. Goodwill, we talked about what is goodwill. Goodwill is when we can't really attach a reason for paying more for it, and these are some examples of why we would pay more for a business than the assets are worth, and we call that goodwill, and you do not amortize goodwill. Okay, we currently do impair goodwill, just like we can impair land, but until they change the rule, we have no amortization. So read through on what a patent is, make some notes on it. You may have some questions on it, but just basically know what they are. So notice that cost $100,000 minus salvage value, which it has none, divided by life. But notice, read them carefully. Don't skim through them, because legal life is 15 years, but estimated useful life is only 8. So obviously, if you had a patent on iPhone technology and you could get that patent for 15 years, we all know that that patent, that technology is going to be out of date in much less than 15 years. So make sure you know it's useful life, not its legal life. And once you think about that, it should make some sense. Okay, then you can look at trademarks. So just read through these, what they are. You have trademarks, franchises, etc. But again, it's useful life, not legal life. The next thing you need to know is research and development costs are not intangibles. You expense them as incurred. This is not what international accounting does, so I believe that's why they bring it up, but we expense research and development costs. Natural resources. Natural resources, again, like intangibles, just know what they are and know the terminology. We depreciate fixed assets, we amortize intangibles, and we deplete natural resources. So here's some examples, and you call it depletion, and it is more like units of output. So I would divide it by the tons of ore, the barrels of oil, the tree foot, I think they call it, of number of tree feet in lumber, etc. So you can kind of read through those. Notice it's called depletion. And there's an example which, again, we debit. You don't debit depletion expense because you actually have a barrel of oil, or you have some inventory of trees, etc., etc. So we call it depletion, but you actually have an inventory because that's generally what I'm selling. So that should make some sense. Okay, I want to go through this additional example I've added to this slide, so just kind of take the whole thing all the way through. So first I'm going to record the purchase. So we have a piece of a purchase is July 1st, so you should always highlight that because that wasn't on January 1st. So I'm going to have a partial year here. Hopefully I remember that. I might have to pause this. Hold on. Goodness, I did. Okay, so I'm going to record the purchase. I have the equipment is expected to have a useful life of 5 years and a salvage value of $1,000. Here's what they paid for it. So I asked myself, was it added to the cost of the asset to get it ready for its intended use? The invoice price, yes. The sales tax, yes, I had to spend that. Shipping, yes, I had to spend that. Installation, yes, I had to spend that. Repair to a wall damaged during installation, the answer is no, I did not. I damaged it during the installation. I didn't negotiate that as far as the purchase price, so I would take this to repair expense. So I need to add those. So my journal entry is to debit equipment, credit cash for $13,000. I ignore the $1,000. If you did do that, it would be repair expense in cash. So now I know my fixed asset cost is $13,000. So I'm going to depreciate it first and second year, assuming straight line depreciation. My cost is $13,000. My salvage value is $1,000. $13,000 minus $1,000 divided by 5 is $2,400 a year. But I purchased it on July 1st, so I have a half year in the first year. So my journal entry for the first and second year is $1,200 the first year and $2,400 the next year. Okay. And after 2 years, the equipment was sold for $7,000. So I go through my steps, get the fixed asset off your books. The fixed asset is on my books for $13,000. I think I should have called this machine. I called it equipment in my original example. Okay, so I get the equipment off my books. It's on my books for $13,000. See, there's my journal entry 2 slides ago. Get the equipment off my books for $13,000. Get the accumulated depreciation off your books. I put in $1,200 and $2,400, so I've got a total of $3,600 in accumulated depreciation. I get that off my books. I sold it for $7,000 cash, so I debit cash for $7,000. I have $9,600 on $10,600 on my debit side, and $13,000 on my credit side, so I need a debit to balance, and a debit is a loss. Okay, and now we're going to make the entries for 2 and 3, assuming double declining balance. So I still have the same purchase entry. I still purchased it for $13,000. But now I'm going to take double declining balance. It's a 5-year life. 1 divided by 5, 1 divided by life times 2 is 40%. I take $13,000 times 40%, but I purchased it on July 1st, so a half year is $2,600. So I have depreciation expense of $2,600 in the first year. In year 2, it is book value times 40%. My book value is $13,000 cost, minus accumulated depreciation of $2,600 times 40% is $4,160. So my journal entry for the second year is $4,160. Now I'm going to sell it. So I go through my steps. I sold it at the beginning, so I don't have a partial year of depreciation. I get the equipment off my books for $13,000. I get the accumulated depreciation off my books, which was the $2,600. And the $4,160, so $2,600 plus $4,160 is $6,760. I record the cash, $7,000. And notice in this instance, since I've depreciated more of it, it's on my books for less. So I've taken $6,760 of depreciation instead of $3,600 of depreciation. So here on straight line, my book value is much higher than it is. So my book value here is much lower. So I have cash of $7,000, and in this instance I have a gain. So notice that just the depreciation method can affect your gain or loss on sale. In all cases, either write it off through depreciation, more depreciation, and adjustment of the gain. Overall, the cash flow is not affected. It's just how kind of when it hits your financial statements. Okay, so I believe that's it. Hopefully you spent the last hour and a half and did it in spurts, because this is a long video. Thank you.